Do you trade using candlestick patterns? And if so, are you profitable with them? If you answered no, then it's likely because you haven't applied these 3 techniques I'm going to be talking about in this video. See, I know this from experience. At the beginning of my trading career, I tried to trade with candlestick patterns and they performed so awful that I was convinced candlestick patterns do not work. But once I discovered the 3 techniques and strategies I'm going to be sharing with you today, candlestick patterns have now become the most profitable strategy that I trade with. So in this video, I'm going to share these 3 strategies with you and show you how you can apply them to your own trading so that you can become a master of candlestick pattern trading yourself. So if that sounds good, go ahead and click that like button for me. Go ahead and subscribe if you are new, and I'll see you after the intro and disclaimer. Welcome back. Let's go ahead and jump right in. So secret number 1 is kind of a 2-parter. So let's go ahead with the first part now. When we're trading candlestick patterns, I want to explain what we're actually looking for. A lot of trading educators will draw out a trend like this. And sure, that is an uptrend, but that's not normally what price looks like, right? What price normally looks like is something more like this. We have price pushing up, then we have some consolidation, maybe another impulsive move, and then finally we keep pushing higher and higher. So when we're doing this, when we're in a trending market, there's gonna be 2 things we're looking for trading our candlestick patterns. Those are going to be extreme highs and extreme lows. You can also call these major swing highs and major swing lows. Doesn't matter what you call them, but let me point them out for you. In a counter trend perspective, when we're looking to go against the trend, which is one way that I trade personally, and it tends to work out pretty well for me, it is favorable if you do it correctly. When we're going counter trend though, what we're looking for is the extreme highs in a uptrend to look for our candlestick pattern as that extreme high. So if price is continuing to push higher, breaking into new highs, we want to wait for a candlestick pattern at the very top of that new high. And what this is doing when we're waiting for new highs and a candlestick pattern is it's giving us the best opportunity to capture this pullback where we can make profit. So if we're placing trades at that brand new high, stop loss above it, just in case price does push up, we just get stopped out, no big deal, and a target that gives us a favorable reward to risk ratio, looking for this pullback from the top of our trend. And we're doing that over and over when we are counter trend trading with candlestick patterns. Now on the trend continuation side of an uptrend, we'd be looking for the bottom of the pullback, and we'd be looking for possible candlestick patterns at the bottom of the pullback in order to capture the next impulsive move higher. So we're just looking for the bottom of this pullback to have some type of candlestick pattern right here at the bottom of it as the swing low of the pullback in order to capture a move higher out of price in an uptrend. And in a downtrend, it would be exactly the opposite. I'll give you an example of that right now. This is what that would look like in a downtrend. We would have prices pushing lower, continuing lower, continuing lower. And what we're looking for counter trend trades in a downtrend is to capture the very bottom of this trend so we can capture some profit on this pullback. The very bottom of the trend, the very bottom of the trend, all these new lows would be considered the major swing low in this downtrend. Next up, for trend continuation, we're trying to capture the very top of a pullback with a candlestick pattern in order to capture the next impulsive move down that breaks below our structure level. So we're looking for the tops of these pullbacks to give us a candlestick pattern. And obviously there's no strategy that's 100%. You will get faked out at times in trend continuation and in counter trend trading, but this is what we're trying to do with candlestick patterns. Now, part number 2 of secret number 1 is going to be to have rules for your candlestick pattern. You don't need to be second guessing if something is the exact candlestick pattern you're looking for. If you're trading hammers, you need exact rules for hammers. If you're trading shooting stars, you need exact rules. If you're trading engulfings, you get the point, right? So what I want to do right now is share with you my rules, my set in stone specific rules for hammer and shooting star candles, because that is the candlestick pattern we'll be discussing most in this video. Let's take a look. On the screen in front of you, you can see a hammer and a shooting star candle. And the way I define these in order to keep myself consistent and never second guess whether I'm actually seeing a hammer or a shooting star candle is by utilizing a Fibonacci retracement tool. So I take my Fibonacci retracement tool from the low of the candlestick up to the high of the candlestick, and as long as the entire body of the candlestick is above the 38.2% retracement, which is my little blue line here, then I have what I consider a valid hammer candle. And it's the opposite for a shooting star candle. For a shooting star candle, I'm looking from the high of the candle down to the low of the candle, and as long as the entire body of the candle is in fact below the 38.2% retracement, then I count that as a shooting star candle. So hopefully that gives you some more clarity on what I mean by having set in stone rules for the candlestick pattern you're using. That way you can stay consistent and you're never second guessing whether or not the candlestick pattern you're trying to use is actually there on the chart. Secret number 2 is never trade candlestick patterns without at least 2 other major technical confluences. Now on the chart, if you want to screenshot this, you can, is my list of major technical confluences that I use in combination with candlesticks. Let me do a brief explanation really fast to explain things a little bit further. So earlier we talked about looking for possible counter trend trades at the top of the move that's in trend, right? We were talking about this level, and this level. Well, if you're doing this in the middle of nowhere with no other confluences, then it's not a profitable way to trade. The only thing that makes candlestick patterns at major swing highs profitable is adding other confluences. My personal confluences, things like major structure levels. A higher time frame major structure level would be even better. What I normally count as a major structure level is a level that's either been tested multiple times or a level that sticks out like a sore thumb. So in this case, this would be a major structure level that would help me make the decision to place this trade. Another major confluence that I use is the RSI indicator being overbought, oversold. As you can see, divergence is even better. So if I have this at a major structure level and I have divergence from here to here, as in prices are going higher, but the RSI indicator is going lower instead of higher, as prices make higher highs, RSI makes lower highs, that would be an example of a divergence. So if I have divergence and prices coming to a major structure level, that is when I can trade a candlestick pattern. But I must have 2 other major technical confluences before I can trade candlestick patterns. And or another confluence that I have is the cross or bounce of an EMA. So I like to use the 50 EMA. Let's pretend this is it. What I would need to see is price cross the EMA, then pull back to the 50 EMA in order to look for some type of candlestick pattern to follow the trend to the downside after this reversal of crossing the EMA, or at least possible reversal. Now to clear this up even further, I actually have 2 live trades I'm in right now on a live account. You can see that looking down here on my Onda live account that are currently in profit, thankfully, and we're going to take a look at the analysis behind them because it lines up with exactly what I've been teaching you today. I used exactly what you're learning in order to get involved in both of these trades. So first off, what are we looking for? What did we discuss earlier? We want to see the lows in a downtrend create some type of candlestick pattern. But that's not all we look for, because if that's all you look for, you will not be right more than you're wrong. You won't have a profitable strategy. We need to add some confluence to it. So the confluence I used on this specific trade consisted of 2 parts. Firstly, we do in fact have a major level of structure that sticks out like a sore thumb here on the Canada Swiss. And also outside of that major level of structure, if we pull up our RSI indicator, you'll see that we do in fact have RSI divergence. As prices are making lower lows here, the RSI has started to make higher lows. With that being the case, this is a great example of RSI divergence combined with a major structure level. And then this specific trade was not utilizing a hammer candle, but it did in fact utilize a bullish engulfing bar right here. And that's when we got involved in this trade directly after that bullish engulfing bar. Hopefully that gives you a little more clarity of this situation. I have a bearish trade I'm in also on the pound dollar utilizing the other confluences that we've already discussed. Let's take a look at that trade now. Here's that live trade. We actually placed this trade last night and we're up somewhere around $2,223 at the moment looking for profits. Hopefully we see this market continue pushing down, but can you spot the confluence I used on this trade and the entry pattern based on what you've learned in this video? So hopefully you were able to spot this entry pattern, because if we zoom in a bit, you'll see that this candle, in fact, meets the rules for a shooting star candle for the way I trade them. The entire body of this candle is below the 38.2% retracement. Also, what is the confluence that we have? So we also have the cross of the 50 EMA, that's my blue line. And although we didn't quite come up and touch it, I do count this because of how close we got as a bounce off of the 50 EMA. So we have a cross and a bounce off the 50 EMA. And with both of those occurring, I count that as two major technical factors. And with that, decided to go short on the close of that shooting star candle. So to close out secret number 2, never trade candlestick patterns without at least 2 other major technical factors in confluence with that candlestick pattern. Again, these are the confluences that I use. If you'd like to screenshot them and use them yourself, go ahead and do so. Secret number 3 is the technique I adopted most recently. I've been trading candlestick patterns this way for about the last 5 years, and it has by far become my favorite way to trade candlestick patterns. And that is by adding candlestick patterns to existing chart patterns. And if you'll look with me right above my face, right above the video, you can see that number 4 on my confluence list is existing chart patterns. So what I mean by that is head and shoulders and inverted head and shoulder patterns, along with double tops and double bottoms. Let me give you an example of a bullish trade where I would use this in combination with a candlestick pattern to actually place a trade. So right here on the dollar Swiss, we can see price coming down. And there's normally 2 different ways that a lot of traders will be trading things like a double bottom. One way would be an aggressive way where you wait for the first bottom, then the second bottom, and you just place the trade when you see price push a bit higher after that second bottom. That would be a more aggressive way to trade a double bottom. A more conservative trader may decide to wait for the break of the neckline of this double top. That would be a more conservative approach to trading this double bottom. But using a candlestick pattern, we can kind of meet somewhere in between, where it's a little bit of a more aggressive way of trading, but not as aggressive as just waiting on a double bottom. Let me explain what I mean. What we'll be waiting on when using candlestick patterns in association with existing chart patterns like double bottoms is for this double bottom to appear and to also, at the end of the double bottom, give us some type of candlestick pattern. So let's actually push the market forward and see if we get that in this specific scenario. So right there, that's not a candlestick pattern we're interested in trading for the bullish direction. But next up, we get what? We get a candlestick pattern. This specifically is an engulfing pattern. So right here, we have a valid double bottom followed by a candlestick pattern being this engulfing pattern. So the exact way I trade using this type of setup is I wait for a scenario that meets my list of confluences. Remember, I have to have at least 2 confluences. Well, we know that we have the double bottom. So we have number 4 checked off. We have an existing chart pattern. So one way I could trade this is if I had an existing chart pattern alongside a major level of structure right here. And then after that existing chart pattern, obviously, I got my candlestick pattern. Another way is I could use the RSI divergence method, which is what we're doing on this trade scenario. So if we look down at the RSI indicator, you can see we have a low right here, which is a low in price. We then get what? We get a lower low in price while the RSI indicator is making higher lows. So that is what we call RSI divergence. So in this case, we have an existing chart pattern combined with RSI overbought oversold divergence, and we have our candlestick pattern. So this again is by far my favorite way to utilize candlestick patterns, is by combining them with existing chart patterns. And in this case, the way I would set up this trade would be something like an entry on the close of that engulfing candle or whatever candlestick pattern you choose to use. A stop loss below the double bottom. For me, I like between a 1.4 and a 2-to-1 reward to risk ratio. We'll go with 1.4 for now. In this trade, I already know what it does. It happens to win. But obviously, every trade doesn't win. Before we talk about that, though, let me go ahead and take you through a bearish example of this so you have a complete understanding of it right now. Hopefully, this one is pretty easy for you to spot, but here we have a head and shoulders pattern followed by a candlestick pattern. See if you can point that out while I draw it out for you. So we have first our push higher, our shoulder of the head and shoulders pattern, our neckline, the head of the head and shoulders pattern, followed by the other part of the neckline here, And what we have pushing up here at the second shoulder is a nice shooting star candle. Right here would be that shooting star candle. So for this specific pattern, what I'm looking for is this head and shoulders. And at the end of the head and shoulders pattern, I want to see a candlestick pattern like this shooting star candle. The trade setup would look something like this, with an entry at the close of that candle, a stop loss just above it, and again, about a 1.4 to 1 reward to risk ratio is what I personally like to shoot for with these trades. And if I click play, although every trade won't win, you'll see that this specific trade also worked out in our favor. So understanding candlestick patterns and these three techniques of how to trade them and applying them will improve your trading. But trading comes down to a lot more than just understanding candlestick patterns. And that is why I'm currently looking for 500 new or struggling traders to mentor throughout the remainder of this year. Throughout this mentor process, you'll get access to a full university style course that'll teach you essentially everything I know and have learned throughout my own 10-year trading career. On top of that, you'll get email alerts when I place trades. And on top of that, you'll get the Pro Trader Report, which is a report every Monday showing you the areas of structure I'm looking to trade in throughout the week. With this mentor program, you also have access to me personally to help you through your trading journey and to answer any questions you have related to trading. So if that's something you're interested in, go ahead and click the top link in the description to learn more, or go to www.thetradingchannel.com. If you're not interested in that, that's completely fine too. Now what I want to do is talk to you a little bit about trading expectations. A lot of new traders come into the market expecting to win every trade. But as I've said throughout this entire video, winning every trade is not possible. What we do as traders is we create a strategy using things like candlestick patterns and other technical confluence, and then we place trades based on that strategy over and over because it gives us an edge over a large sample size of trades. The strategies that we've talked about in this video may win between 55 and 65% of the time. Now, when you think about that, it may sound good. If you can get above a 1-to-1 and get above a 50% chance to win, that would be profitable over a long period of time. But what you're not thinking about is that means out of every 100 trades, you will likely lose 40 to 45. You will lose nearly half of those trades, more than likely, because no strategy is going to give you that 90% win rate with a 3-to-1 reward to risk ratio that I know I was looking for at the beginning of my trading career. And it took me a really long time to realize that that does not exist. And that what we're doing, again, as traders, is creating a strategy and then letting the edge we have with that strategy, with our combination of technical factors, we're letting that edge play out over a long span of time, and that's what creates profitable trading. And if we do that consistently, that's what can really build a trading account to massive size. So as I end the video here, I'll give you some other things that you can go study to help improve your trading. And that would be, after learning about candlesticks, learning strategies, applying those strategies, creating your own strategy, whatever that may be. After you have that strategy, there's other things you need to work on. You need to go study up on risk management. And I don't care if you do it through the risk management videos we have here on our channel, or if you go look up other people's channel, you read books, however you learn best. But you need to learn about risk management and the effect it has on your emotions so that you can apply a good risk management plan while you're trading, and also go study up on trading psychology. I would personally suggest looking at anything Mark Douglas has written or recorded as a video, because that is one of my trading psychology mentors, and learning from him has helped my trading psychology and helped me to master my trading mindset. So yet again, if you want to learn more about this 500 trader army I am building, you can click the top link in the description or go to www.thetradingchannel.com. If not, that's completely fine too. Make sure you're subscribed here, like the video if you enjoyed it. Be sure to comment below if you made it to the end, and I'll talk to you in the next video. See you soon.